This clip covers the contents of Chapter 9, which deals with the development of strategic performance management systems. So this is the final bit of content that we're going to cover this year. And if we look back at what we've done in this year around the rational planning model, we said that we started off with the mission, vision, and objectives of the organization that we set in line with the overall strategies of the organization. We then moved on to the position appraisal, in which we identified the strengths and weaknesses in the internal environment. We looked at the opportunities and threats that exist in the external environment or the organization's ecosystem. Okay, after that, we generated strategic options, and we used the SAF framework to evaluate specific strategic options, and then you recommend on the strategic options. After that, we focused on implementation through change management, digital strategies, and today we're going to look at the review and control. So how do we measure the performance of the actual strategies that we've implemented compared to the original objectives that was set at the beginning? And then you will take corrective action in terms of adding additional strategies or tweaking some of the things that you are currently doing. Okay, so as always, we're going to look at what are the outcomes, and this is according to the CIMA syllabus. What will I require of you in the exam in November? So the first thing, so what is the overall thing? So to develop a strategic performance management system. Now in that, I often give you the actual performance management system, and you have to evaluate the current performance management system and make recommendations on how to improve it. So what are the strengths and what are the drawbacks of the specific performance management system? Okay, so or you could just, as it says there, develop a performance management system. And we will look at different tools that you would use to do that. Okay, so as I said, so the more specific outcomes over here, it would be to develop detailed action plans, communicate the communication of the action plans. How do we monitor, and this is really where it focuses on, how do we monitor the implementation, and to align incentives to the performance. And with regards to incentives, I have uploaded a clip on Blackboard that actually explains the motivation of different performance management systems and the actual things that motivate employees. Okay, so what it is, it's action plan, so it's target setting, critical success factors, key performance indicators are the specific content that will be covered in this chapter. So later, you will see that, so the performance management systems, we will firstly look at how does performance management link to strategy, the difference between financial and non-financial ratios. We will investigate the different models of performance management. Then we will look at benchmarking as a tool. How do you measure divisional performance in an organization? How do you communicate the performance management plan, and then setting stretch targets? And finally, we will just look at integrated reporting as a measure of communicating the organization's performance to all of its stakeholders. So firstly, we're going to look at what is the definition of performance management. Okay, so performance management is the process of assessing the success of the strategy or the strategic actions that we've taken by measuring how economic the acquisition of the resources were and how effectively were those resources deployed within the organization in achieving the objectives, and you measure the success based on both financial and non-financial performance measures. Okay, so nearly has identified something which he calls the 4 CPs of how do you control what people do. And normally these things are not asked in a scenario-based question. It is important to know them for objective test questions. And the 4 CPs that is identified is to confirm priorities, compel progress, check the current position, and then to communicate the current position to your employees. Performance management is the extent to which an organization met the specific objectives that they set. So in this case, we need to measure how successful a company was in implementing its strategy. And we therefore need to link the strategy of an organization to its performance management system. So let's just look back at what a strategy is. In chapter 1, we said that the generic strategy of an organization could either be a cost leadership, a differentiator, or a focused cost leadership or differentiator. So a company should generally follow one of those strategies, and then once they know what their strategy is, they would then set specific objectives. And those objectives and the strategy, you need to ask yourself, what are critical? What are the critical success factors in us meeting our overall strategy and the value proposition that we have for our customers and all our other stakeholders? Okay, and then once you've identified that, you need to say, but how do we actually measure whether we're doing our critical success factors or we're actually achieving success on our critical success factors? And we do that through linking the critical success factors to key performance indicators. And it's often helpful if you could look at, firstly, what the critical success criteria is. So for us to say achieve innovation, what is important in terms of the innovation that we need to achieve in this specific organization? And then from there, you say, if this is the criteria, how do we measure that we've actually met the criteria? And to me, this is so important. This is the crux of what we are doing in this module. It is actually linking strategy to accounting. And how do you do that? Is through the measuring of KPIs, through identifying your critical success factors. And this is why I have focused on critical success factors and key performance indicators in this year, because that is what you're going to have to, or this is what you going to be required to do if you work next year. And even if it is just any project that you work on, you need to know what is really the critical success factors. What are the things that we need to do well in order to achieve the objectives set out for the specific thing? And if you've identified that, you can say, but how would I measure whether we're doing this right or wrong? And let's just have a look at an example. Looking at the Sunscape Hotels of Assessment Opportunity 4 as an example. Okay, so what was their strategy? It is a differentiation strategy. And that differentiation strategy was based on quality, on customer service, branding, providing luxury rooms, facilities, and restaurants. And for the industry, and this is where a lot of students didn't pick up on this, for the industry, doesn't matter whether you're a budget or a luxury hotel, whether you run a lodge, whether you run a guest house, if you have any accommodation that you sell, occupancy for that industry is a critical success factor. Okay, then if we look at how do we then measure these things? So occupancy is measured through, guess what? Occupancy rates. Customer service or customer experience could be done through customer satisfaction ratings, star ratings of the hotel and the restaurant, website comments, likes. That is how you would measure that you actually provide a quality service to your customers, and that your facilities are meeting their standards, and that your restaurant is up to standard. Okay, so that is the link, as I said. The link between strategy and performance is done through the identification of critical success factors and measuring the key performance indicators. So to implement a successful performance management system, you have to include both financial and non-financial performance measures. So traditionally, companies only used financial performance to measure the success of a company. And typically, those measures include sales growth, your gross margin, your net profit margin, your earnings per share, increases in costs, increases in sales. So it's a combination of measuring both your income statement performance and your balance sheet performance. Now, the typical measure that you would use will depend on the organization or the business model of the organization. For retailers, for example, sales growth is very important. Managing your gross margin. So for retailers, managing the income statement is more important than managing your balance sheet. If you're a property investor, on the other hand, your income statement becomes less important than your balance sheet. So it depends on the industry what kind of performance measures you would advise. Okay, and the financial performance really just tell you or gives you an indication of the financial success of the organization. So what are the advantages of financial performance measures? So culturally, it is expected. People know that they will be measured based on financial performance. This is what shareholders want, is to at least for companies to report on the financial performance. And because of that, because of the importance of that, employees are expected to be measured on financial performance. Okay, it focuses on the financial objectives of the organization. So if your organization is profit-driven, financial objectives make sense. It's easy to compare financial information because it's less subjective. Transactions are recorded, you have the financials, you know what the profit of the organization is, and you can compare it to a different division or to other companies. It's cheap to implement because it flows from your financial statement. It's an established framework and people understand it. And it focuses on resource generation and the long-term survival. Although it doesn't focus on long-term success, financial performance, if a company is financially successful, it does indicate long-term survival. But then it has serious disadvantages as well. So firstly, it is the controllability of certain items. We will later on talk about investment centers, profit centers, and cost centers. And when you measure the performance of a division, it's important to know that when somebody is measured on a specific item, say sales growth or profit margins, that they did actually have control over the expenditures, or that they did have control over the sales. Because if they don't, people become negative. Then often, and this is a big thing, is short-termism. If you look at financial statements, it is often an annual thing. And because of that, people manipulate short-term profits. They don't incur expenses that are required, or they may increase or decrease profitability through provisions or non-cash items. Okay, so often comparability may also be an issue, especially if you measure two divisions that has very different business models. Some people who don't have a financial background may not understand the measures, and it could also be seen as being subjective. As I stated, it is open to manipulation, especially if it is only profitability. The valuation of assets are often a problem, and the real business issues are overlooked. Because remember, financial statements is historic information. So by the time that these things are reported, the problems are often already advanced. So the problem with financial measures is often rooted within the problems associated with the accounting treatment. So as I stated, your financial measures, the information that you get to calculate those measures, you would get from either your income statement or your balance sheet. Now, first, let's just look at the income statement, the problems there. So if you use profitability to determine the performance of a division, it has certain problems. So if you think of profit includes sales less expenses. Okay, so what managers want if you use profitability as a performance measure is to smooth your profitability. So you don't want huge outliers. So one year your expenses, your profits goes up, the next year it goes down. So what managers want is they want to slowly grow year on year. And to do that, the profitability can be manipulated by those managers. And how do they manipulate the figures? Using two techniques. The first one is that profits or expenses include provisions. So you could raise a provision if you want to reduce your expenses, and then you can release provisions again if you do not, if you want to increase your profitability. So profit includes non-cash items, which is a disadvantage because it can be manipulated. The second thing is that as soon as things go tough, the first thing managers would cut on would be essential expenses that would not necessarily have a short-term impact, but will be to the detriment of the company over the long term. And those expenses include things like advertising, research and development, staff training. Over the short term, it doesn't have an impact, but over the long term, it has significant impacts. So managers could decide not to incur those expenses in order to inflate short-term profits. Okay, so that's the profitability side. Then on the balance sheet side, the major concern is the valuation of the assets, because you typically have, if you use the balance sheet, it would be a return on investment, a return on assets. And the issue lies with the actual value of the asset. What do you use? Do you use replacement value? Do you use book value? Do you use revaluation or revaluated assets? And how do you compare the assets of different divisions? Because it doesn't matter whether you use a revalued asset value. If you invest in assets, immediately the cost of your assets go up and your return reduces. So managers are not incentivized to invest in assets which may be necessary for the long-term growth of the organization. And that's the problem with investments. Let's look at non-financial performance. So the definition of non-financial performance measures, it is based on non-financial information. So it is things that you do not get on the income statement. So it originates within the business. And it could, typically your critical success factors are a good source of non-financial performance indicators, because from your critical success factors, you will get key performance indicators. And those key performance indicators of quality, innovation, branding and satisfaction, production levels, those are all non-financial measures. Also in your balanced scorecard, if you look at the customer perspective, learning and growth, and the internal processes, all of those require non-financial performance measures. Okay, so what are the advantages of non-financial performance measures? Firstly, it provides a wider view and it deals with problems immediately. As I said, with the financial performance measures, it is historic. If you have a good set of non-financial performance measures, you could easily see where the source of your problems are. So it deals with customer requirements, it deals with competitors and your long-term strategic goals. It emphasizes the source of profit rather than the profitability itself. It's often easier to calculate. It's not distorted by things such as inflation or economic conditions, and it is harder to manipulate. And it's sometimes easier for non-financial staff to understand these measures. And it also has higher motivational implications because people understand what is measured and how it relates to their day-to-day jobs. So some of the disadvantages is, although it may be easier to calculate, it's often harder to find the information to determine the performance measure. Some subjectivity still exists because there are no accounting standards that specify how a specific measure should be managed. Okay, and then it often relates in, or could result in indicator overload. So you have so many non-financial measures that people do not know what to focus on. It's costly to calculate, typically because of the difficulty of getting the information. It may result in culture clash implications. So certain divisions have different cultures, and that may not be accepted well. And then constant change requires constant monitoring. So in today's life, there's constant change, and because of that, the measures would constantly need to change. The outcomes of this chapter specify that students need to be able to design a performance management system and then also to evaluate an existing performance management system. So when you're required to design a performance management system, it is important that your performance management system includes both financial and non-financial performance measures. And on this slide, a list of what those measures may be on the financial side and then also the non-financial side. There are obviously some others as well, but this is just examples of the things that can be included. Then when you need to evaluate existing performance measures. So what I will do in this scenario is I will give you an existing system and include it in the scenario information. There may be some hidden problems or advantages included, and you then have to evaluate. So if I say evaluate a performance management system, you need to say to what are the advantages, what are the strengths of the performance management system, and what are the drawbacks of that specific system. And then I may ask you to recommend improvements on the performance management system. So how could I, for example, adjust the financial indicators that we use? What are better financial performance indicators, and which non-financial indicators may be included in such a system? So that would typically be the type of scenario-based questions that you can expect on this chapter. So when assessing the performance of a strategy, a company, a division, it is important that you compare the financial and non-financial measures to something. Okay, so it must always be measured against either an objective. So to what extent did we achieve this? I often see when students calculate financial performance that they just look at the quick asset ratio and say, oh, the quick asset ratio is good or bad, or it increased. But against what do you measure performance? So also remember this if you do a financial strategy question, for example. If there's any type of measure, you always need to assess it against either the objectives, a budgeted figure. If you use standard costing, what is the standard and what are the variances when we compare the actual performance to the standard? Historically, what has happened? Okay, how do we compare this performance to other parts of the business? How does this performance compare to our competitors? Or how does the performance measure against the future potential? What is the gap that we still need to address? So very important, always measure or assess against some kind of measure. And that often makes it easier if you just know that you need to look at what are the standards that I'm assessing this against. So we've said that when designing a performance management system, that companies should use a combination of financial and non-financial indicators. So instead of designing a financial performance indicator system, there are three approaches which has been developed that specifically combine, that provides a model for using financial and non-financial indicators and how they should be used. And the first of those are the balance scorecard, and I've mentioned it previously. So the balance scorecard says that you need to have a combination of financial performance management measures, some performance measures that focus on customers, some on your internal operations and business processes, and the fourth one on your innovation, your learning, and your growth of the organization. And if you use these four perspectives, you will automatically have a balanced performance management system, and that's why it's called the balance scorecard, of both financial and non-financial indicators. Okay, another one is the performance pyramid. And the performance pyramid looks at external and internal efficiencies. And the internal efficiencies are measured through the production of the company, and the external is measured through your customer perspective, and the internal efficiencies through financial performance measures. And the third one is the building blocks model. And in the building blocks model, we look at what are the dimensions, the measures, what are the standards, how are standards set on each of those dimensions, and it also includes the rewards. We are firstly going to look at the balance scorecard. So the balance scorecard was developed by Kaplan and Norton in the 1990s, and was based on their research that they performed that stated that accounting has lost its relevance. And the reason was that traditional performance measurements are inadequate for assessing overall performance. And secondly, because financial reporting is heavily retrospective and it doesn't focus on the actual information that is relevant to the organization at a specific point in time. So the balance scorecard, as stated, covers four angles, four perspectives of performance. And although they recommend the four performance perspective, each individual company can decide which measures they want to use specific to their company. So as you can see, this is the balance scorecard, and the vision and strategy of the organization is sitting at the heart of the balance scorecard. So when looking at the different perspectives, you would firstly consider it in line with the vision and the strategy of the organization. So the first thing that we're going to look at is the financial perspective. And according to this perspective, you need to say what does the organization need to do to appear successful to its shareholders. So what are the things that the shareholders look at to determine whether the organization is successful or not? And that is the profitability. That's the profitability and the balance sheet. Okay, then the customer perspective, and this is where you ask yourself, what is the value proposition that we offer to our customers? So to achieve our vision, how should we deliver our product to our customers? Then thirdly, you would look at measures that determine or assess the success of the internal business. And in this perspective, you look at how to satisfy our shareholders and our customers, what business processes must we excel at? So key here is both the shareholder and the customer perspective. So internally, what this means is that you need to perform your business processes internally in such a way that you are still profitable. In other words, how should we do it efficiently so that we deliver good financial results? And the second leg is, how do we deliver the processes efficiently in a way that we effectively service our customers? So it's both the financial side plus the value proposition that is included in there. And then finally, it is the future-orientated perspective, which focuses on how do we learn and how do we grow. And to achieve our vision over the long term, how do we sustain our ability to change and to improve? So how do we grow? How do we innovate? And this is what that perspective focuses on. And we're now going to look at specific measures that is included in each of these perspectives. So firstly, the financial perspectives, I've included some cash measures in there. But firstly, as I said, how do we create value for our shareholders? And the traditional, what Morton and Kaplan has said is that traditional financial reporting and financial measures should not be overlooked, because in the end, your organization is there to create or to be profitable. And things such as market share and share growth should be included in there. And you could also include modern measures such as value added, economic value added, or shareholder value analysis as part of the financial perspective. So when you do the balanced scorecard, don't exclude other financial measures that we will discuss later on. Then the customer perspective, it is how should we appear to our customers? And it concentrates on the value proposition to our customers, and it's closely linked to your critical success factors of your strategy. And it may be concerned with time, quality, performance, service, costs. So what do my customers need? And I've included some examples of measures over here. Third one, as I said, learning and growth. This is how do we continue to improve and create value? And it is the forward-looking perspective. And performance measures include the time to market, for new products, number of innovations, staff training, staff development, investment in research and development. Those could all be measures. And finally, the internal business process perspective. This is where we focus on the efficiency and the effectiveness of our operations internally. So excellence, are there any wastage? What is the quality? Are there any errors? What is our productivity, the efficiency, and the cost and the competencies and the skills of your the core competencies and the skills that you require for your internal perspective. So it measures all of that. Over on this slide, I've just given you, once again, just a list of possible indicators that can be used if you are unclear or you don't know what types of financial or what type of indicators you can use. But please bear in mind that you can't just in an exam dump these measures. It has to be linked to the strategy of the organization and their business model, specifically for the financial perspectives. For all companies, sales growth may not be important, or growth in revenue, although it's fairly standard, but a return on investment may be more appropriate for one company versus another one. Market share would be more important for a retailer than it may be for a service organization. So look at the organization that is given in the scenario, and based on that, you would select the most appropriate measures. If your measure is not appropriate, similar to that when I asked for the matrices in assessment opportunity 4, if your measure is not relevant to that specific company and industry, you will not get a mark, because that is where, in the scenarios, we test the application. And the appropriate measures are therefore important. Okay, so after developing the balanced scorecard, Norton and Kaplan has said that has developed the strategic mapping, where they really explain how you should use the balanced scorecard as part of your strategy implementation. And they've identified the following steps that you need to include, and these steps are often asked as OTQs as well. So you need to say, so firstly identify what is the overall overarching objectives of the organization, and how, in which way do we create value? And that is your generic strategy. How do we create value to our customers? And then from there you say, identify the financial strategies to support the value creation and the achievement of the overall objectives of the organization. You clarify your customer orientation, you identify the internal processes, and finally, what skills and competencies would you need in the future to be successful? And over here, this is typically how the balanced scorecard is used in practice, and also how I ask it in an exam. So go back to previous exams, 2018, 2019, 2017, and look at the balanced scorecard. I'm not sure specifically where I've asked it, but I often ask the balanced scorecard in the final exam, or even assessment opportunity 4. So go back and look at how the balanced scorecard has been asked. And it would typically be in this format. I think I may have refined it a little bit this year. But firstly, as I said, like if you follow the steps that is set out in the strategy mapping process, this outline talks to that. So firstly, you look at the objectives of the organization. And this will be the overarching objectives. And typically, these are the things that are included in the case scenario. What are the objectives of the organization? And the organizations should set objectives for each of the perspectives. So for the financial perspective, for the or shareholder-based objectives, customer objectives, staff learning and growth objectives, and then also internal processes. Okay, so those are the big overall objectives. The critical success factors, and please remember, critical success factors in the context of the balanced scorecard is different to Rocket's definition of critical success factors. Critical success factors in the balanced scorecard is what is critical to achieve this. What are the things that I have to do well over here to achieve these objectives? Those are the critical success factors. It may be, because in here, critical success factors may be sales growth, where in Rocket's model, it would never be sales growth. That is a strategy-specific critical success factors. In the balanced scorecard, it is what are the critical things to achieve the specific objectives of the perspective. KPIs, how do I measure this critical success factor? So if I say growing sales are important, critical in our business model, or maximizing the margins, or increasing your gross margin. This would be, how do we measure this? Through the KPIs. This is monitoring the gross margin, reducing variable costs or input costs. Those are specific KPIs. Then the target, what is the target? So this is more your SMART objectives. And you will set one for each of your either critical success factors or key performance indicators. What is it that I want to achieve with this specific measure? And the final thing is, what initiatives should I put in place to ensure that we achieve the targets, firstly, or the objectives overall? What are the things that we need to include? And I've provided an example here below on the hotel group, on the Sunscape hotel group that we had an assessment opportunity for. So let's look at the customer perspective of Sunscapes. The objective that was given in the scenario was to deliver high guest satisfaction. How do they do that? Through personal service, providing luxury rooms and excellent facilities. That is what the customer or the strategy of this organization is built on. That's just on this. If I said earlier, so the customer perspective, if you look at your, this would typically include Rocket's definition of critical success factors in the customer perspective. Okay, so why do my customers buy from me? What is the value that I offer them? And what are important to them? So the KPI for measuring, and yeah, the KPI customer satisfaction ratings would include both, is a good measure for measuring personal service, luxury rooms, and excellent facilities. The number of repeat bookings, net promoter scores, which is the difference between positive ratings and, or would I recommend this this company versus less the people who said, no, I wouldn't recommend this company. Could look at restaurant ratings, for example. And then the target, what do we want with the KPI? How do we measure it against what? Is to say we want customer satisfaction ratings above 9 on specifically personal service, room quality, and facilities. What initiatives can we take? For example, and there could be numerous ones that you could select, but they must be relevant and they must relate to achieving your objectives. So refurbish your rooms every 5 years. Employ a Michelin star chef. Those could all be initiatives taken to specifically achieve my target performance and the critical success factors, which in turn would result in you achieving your objectives. So this is an example of how the balanced scorecard would be developed and how it will be asked in the exam. Okay, then over here, I've just listed the benefits and the disadvantages of the balanced scorecard, and you can go through these things on your own. Okay, next we're looking at the performance pyramid. So the performance pyramid, as I stated earlier, looks at the internal effectiveness and the external effectiveness and the internal efficiency. And if you can actually look at this performance pyramid and draw a line through there. And these measures on the left-hand side look at the external efficiency, so your market satisfaction, and the internal things is your is measured through your financial measures. So how well do we perform internally? So your market satisfaction looks at a customer satisfaction, and then flexibility is a combination of the productivity and the extent to which we measure or we meet our customer needs. Okay, and then on the operational level, this is really where the actual work is performed. What is the quality of the product? Do we deliver on time? What is the process time? Can you see internal? And what is the wastage? Okay, and what it also says is that you typically at a corporate level, so at the top of the organization, they would look at these measures. So if you are the CFO or the director, the board of directors, you would be interested in overall what is the market satisfaction ratios and what does my financial measures tell me overall. Then at a business unit level, okay, the actual people who are in charge of the delivery of the product. You would look at customer satisfaction, the flexibility and productivity ratios, because this will tell you immediately if there's something wrong within the operations of the organization. And then at the operational level, people who work in the factory, for example, would be interested in the quality, on-time delivery, the time to process the products, and the wastage that is incurred. Okay, then also you could just look at the strengths and the drawbacks of the performance pyramid. Why you need to know the strengths and the drawbacks, as I said, is because if I say that the company uses the performance pyramid, you need to be, if you have to evaluate the performance management system, you need to know what are the strengths of the system and what are the drawbacks in order to evaluate. Then the last model that we're looking at would be the building blocks model by Fitzgerald and Moon, also often asked in OTQs, the same with the performance pyramid if it's not asked in a scenario-based question. I've not done it before, but it doesn't mean that I may not do it in future. Okay, so the building blocks model was developed mainly for the services industry, but it can actually be used in all types of service, in all types of businesses. And the reason why Fitzgerald and Moon specifically developed this is because in a service industry, you typically have things that must happen simultaneously. It is perishable, so you use it, you have your hair done once and then it's done. It has heterogeneity, which means that it is just different people do different things. So it's not the same. You can't standardize it. It is often intangible because it relates to service. And then there's no transfer of ownership. If you've had your hair done or your nails done, it is done. So you have new nails, you have hair, but there isn't a product that physically leaves. Perhaps with nails and hair there is. But typically with a service, it is something that you offer. And so this model has been developed to address some of these issues. So on the top over here, we will see the dimensions, and this is the actual measures that could be included. So it could be profit, competitiveness, how did we use our resources, what is the quality, what are the flexibility and the innovation. And you could actually also consider the balanced scorecard things when you come up with the measures. So what the building blocks model does in addition, it says that how do we deal with the standards that we set? Okay, where the other models didn't look at this. If you think of the balanced scorecard, these are the models and these are the reasons why we use it. But with the building blocks model, it says that you cannot have successful performance management if your employees do not take ownership, if they do not view the measures as achievable and equitable. Okay, so if you have stretched targets that are not achievable, the dimensions doesn't mean anything. And then they also say that your rewards must be linked to your measures. And for your employees to achieve the dimensions, they must be clear on what they must do to achieve to receive a reward. It will they must have motivation and they must have control over the achievement of these dimensions. We have now come to the end of the first part on the chapter that looked at designing strategic performance management systems. So let's just recap on what we have covered so far. Firstly, we looked at the link between strategy and performance, which lies in the identification of critical success factors and key performance indicators. Secondly, we discussed the importance of using both financial and non-financial measures when designing a performance management system. On the financial side, it would include financial ratios, but on the disadvantage, it is the controllability over specific ratios that are included. And on the non-financial side, the major advantage was that non-financial indicators provide an immediate view of the factors that impact the wider organization. And then finally, we looked at specific models that were designed to include both financial and financial performance measures. We firstly looked at the balance scorecard, the performance pyramid, and then Fitzgerald and Moon's building blocks model. In our next session, we will look at the remainder of the issues covered in Chapter 9.